How would it feel if you lost all the money that you have in the world and more? Every year, hundreds of thousands of regular Europeans go through personal bankruptcy. Some of these people simply got unlucky, but in most cases, they made poor money decisions and completely avoidable mistakes. Over my 18 years in finance, both on Wall Street and here in Europe, I've even known millionaires who went broke because of these mistakes. So in this video, I will show you the biggest dangers that can cause you to lose everything and my top recommendations for making sure that never happens to you. To explain the first danger, let's look at the most popular piece of financial advice here in Europe. Your friends say this, your parents recommend it, everybody's doing it. To build wealth, buy real estate. On the face of it, this is sensible advice. For thousands of years, real estate has reliably increased in value. If you buy a house for yourself, this forces you to save every month as you pay down the mortgage. If you buy a property to rent it out, you get a good monthly income. But there's a problem. A typical house or apartment costs anywhere between 100,000 euros and €1,000,000 or more. Most Europeans don't have that kind of cash sitting in the bank, so they take a bank loan, a mortgage. This is so common, such a normal part of our daily life here in Europe, that very few people think about the risks. Most of the time, having a mortgage works out fine. The bank lends you money, you buy the property, the price goes up over time, plus maybe you get some rental income, so you slowly pay down the mortgage and everybody's happy. But let's say there's a housing crash. Property prices go down, so suddenly you owe more than the value of the house. This often happens when the economy crashes at the same time. So maybe your tenants stop paying rent and you lose your job and you just can't cover the mortgage. Within months, the bank forecloses on you. It takes away the house and sells it on the market. And here's the nasty part that people don't think about when getting a mortgage. In Europe, most mortgages are what are called recourse loans. If the bank can't get enough money from selling the property, it will come after you for the rest. And just like that, you're deep in debt and broke. Now, to be clear, a mortgage is probably the smartest type of debt that you can take if you're being reasonably conservative, if your down payment is 15 to 20% of the property value or more, if the monthly mortgage payment is well within your budget, and if you've got an emergency fund sitting in the bank which could cover the monthly payment for a while, then the risks are significantly lower. That said, in the big financial crisis between 2007 and 2010, millions of people globally lost their homes to foreclosure, and only part of them were reckless real estate speculators. Many people simply lost their jobs and couldn't afford to cover even their reasonably sized mortgage. The point is, taking any kind of loan significantly increases your risk of going broke. And of course, if you take less responsible types of debt, like consumer loans, payday loans, a personal loan to launch a business, that is much more risky. So the first danger that can make you go broke is debt. And my first recommendation is simple. Stay away from debt, other than perhaps a reasonably sized mortgage that you can comfortably afford. To explain the second danger, think about subscriptions. For most people, it's very easy to upgrade a subscription. Just a few clicks and suddenly you've got Netflix Premium, YouTube Premium, Spotify Premium, Amazon Prime, expanded cloud storage, and much more. Each individual upgrade feels small. You can afford those extra 5 to 10 euros per month. And you know that canceling takes just a few minutes, so why not try it out? But once you have all these subscriptions, it is surprisingly difficult to go back because you get used to having no ads, to unlimited storage, to having lots of shows and movies to choose from. Giving all of that up feels almost physically painful. Well, that is just a miniature version of the second danger that can make you go broke, which is lifestyle creep. Let's say you have a really good year at work, so you have a higher income. Maybe you feel like you can afford a bigger apartment or a nicer car. But now you've got three problems. First, you've got new fixed costs, like higher rent or a bigger car payment. Second, you are now used to a higher standard of living. And third, your friends and family have seen you enjoying this new standard of living, and giving that up can feel humiliating. So if the economy slows down, or if there's a problem at your job, people just tend to keep spending and hope that it's going to work out somehow. And if it doesn't, you reach for your credit card or a payday loan, and before you know it, you're broke. So here's my second recommendation. Grow your spending 50% slower than your income. That means that if your salary goes up by 500 euros a month, you can allow yourself to spend 250 euros more, but you should save and invest the other 250 because you don't know how long the good times will last. All right, the third danger that I want to highlight primarily applies to wealthy people, to those of you who are already living off your investments. The problem is that investment income varies dramatically from year to year. For the last 3 years, the S&P 500 has earned tremendous profits. So when you see your brokerage account growing this fast, it is easy to feel like you can afford to spend a lot more. But that is a quick way to deplete your portfolio and go broke when the inevitable market correction comes. So the third danger I want to highlight today is spending according to your investment income. And the third recommendation I have is spend according to your wealth. In practical terms, if you live off your investments, you should aim to spend no more than maybe 4 to 5% of your assets per year. There's a few different ways you can do this. You can take 4% of your current portfolio value and then increase that amount by inflation every year. That's the famous 4% rule. And while it has its risks, it can be a decent start. Or you can vary your spending from year to year as long as you never spend more than maybe 4 to 5 or at most 6% of the portfolio size. Just keep in mind that this can get difficult because when the market drops, you have to drop your spending significantly as well. But whatever you do, don't let high investing profits fool you into lavish spending. To explain the next danger to your wealth, imagine that you live in America. Let's say you own a house, including the sidewalk in front of it. It's wintertime and the sidewalk is icy and you haven't cleaned it. If somebody slips and breaks their hip, they might sue you for tens or hundreds of thousands of dollars. Here in Europe, that kind of scenario is much less likely, but you could still get wiped out by our fourth danger, which is personal liability. And here's how. If you're self-employed, in many countries, you will have direct personal liability for your professional activity. So if your work causes injury or harm, you could get sued. The same goes for partnerships and other legal structures that don't limit your liability. But you're not fully safe even if your business is a limited liability company, because if you're a company director and you break the law or you fail to fulfill your duties, you can still get sued by your investors, be forced to pay fines by the tax authority, or worse. So my recommendation number 4 is this: clearly separate your private and business lives. In some cases, you might need something like directors and officers liability insurance to keep your personal wealth safe. Speaking of insurance, well, we are better off than in America, where getting sick can be enough to send you into bankruptcy. Here in Europe, a severe sickness or disability will usually not lead to millions in medical costs. But if you lose the ability to work, that is still a real danger to your finances. So my 5th recommendation is insure what you cannot afford to lose. Consider disability insurance, life insurance, as well as insurance for your home and car. Next up, we have a really fundamental financial danger. This one wiped out my friend Jerome in New York back in 2009. It was the middle of the financial crisis. Stocks were down 50%, and Jerome was forced to sell his portfolio at the worst possible time. Not because he wanted to. He knew the market would eventually recover, but he needed money to feed his family, so he had to sell. The mistake Jerome made, and this happens very often, is not having a safety cushion. So make sure to follow my recommendation number 6. Always have a financial safety cushion set aside. This is money sitting in the bank, enough to cover a few months' living expenses, even if you lose your job and even if the economy or the market crashes. The idea is that you are not going to be forced to sell your investments at the worst possible time because you will have some spending money. And this brings us to the question of investments. How do you invest to make sure you never go broke? Over my almost 2 decades in the investment world, I've seen investors lose money in many different ways. But when it comes to going broke, there are 2 dangers that are worse than everything else. The first danger is not understanding the difference between investing and trading. Investing is all about finding good long-term investments and holding them for years. Trading is all about gambling in the markets. Buy a stock at 10 a.m., sell it at 10:15, make a profit, and repeat over and over again. I have known a few profitable traders over my years in finance, but the vast majority of people do really badly at it. For example, this study of Brazilian day traders demonstrated that only 3% made any money at all, and only 0.5% earned more than the starting salary of a bank clerk while taking big risks with their money. And if you trade with leverage on borrowed money, you can not only lose your savings, you can actually get deep in debt within seconds. Just browse the popular Wall Street Bets forum on Reddit to find story after story of traders who went spectacularly broke. So if you don't want that to happen to you, stay away from all forms of trading, such as day trading, Forex, CFDs, options, and more. To explain the second critical danger to investors, let me share an investment mistake that I made just a few years ago. A company I co-founded had just gone public, so I had some spare cash, plus I felt smart and successful, so I decided, let me try startup investing. Everybody's heard stories of early investors in Skype or Amazon or Nvidia who struck it rich. Why not me? I started looking for these investing opportunities, and as it turned out, my neighbor had a startup. I went and saw their office, checked out the cool gizmo that they were building, and I thought, okay, well, this looks promising. And I invested 25,000 euros. What happened next? Nothing. The startup basically imploded and I lost my money. So what was my mistake? Was it picking the wrong startup? Well, not really. Even the most successful startup investors will back many failures for every startup that succeeds. My mistake was not listening to a friend who warned me 25,000 euros per startup is way too much for a beginning investor. You should start with 5 or 10,000 max. Make a lot of small bets because startups are risky. And by the way, this is assuming that you already have many hundreds of thousands or potentially millions to invest, okay? Small, regular investors should not be investing in startups at all. Now, in my case, fortunately, the mistake was not too bad. I could afford to lose those 25,000 euros. It was just a small fraction of my savings. Most of my money remained safe in my ETF portfolio. But this same kind of mistake wipes out investors all the time. Maybe you get excited about some stock or some startup or some investment opportunity and you put in 30 or 50 or even 70% of your life savings. And when it fails, you're wiped out. So here's the second major danger to investors: over-concentration. Putting too much money into a single investment. The thing is, yes, most startups fail, but even major established companies run by experienced management fail all the time. In the stock market, around 11% of all stocks go to zero at some point. According to JP Morgan's Agony and Ecstasy report, around 40% of all stocks experience catastrophic losses. This is where you lose 70% of your money and the stock never recovers. If you put a big chunk of your portfolio in just a few single stocks, you're taking tremendous risk. That is why my number one recommendation for any investor is simple: diversify your investments. Your portfolio should ideally hold several hundred different stocks across multiple different industries and regions so that no single failure can wipe you out. Now, what is the easiest way to diversify? Well, of course, today it's ETFs and index funds. You can buy a simple ETF that invests in hundreds of different companies all around the world with just a few clicks. The only problem is getting started, because to a beginner, ETFs can feel confusing. What does ETF even stand for? How does it work? And where can you buy one? To find that out, watch this video next, where I explain how to get started with ETFs here in Europe.